This video is for those who have no idea what the Fed funds rate is and don't understand how it affects the economy. Why is the interest rate going up? Why is it going down? Who is this guy on TV and why does it matter? Don't worry that today I will explain what the Fed funds rate is and how it affects your pocket. An interest rate is basically how much it costs you to borrow money. So for example, if I need $100, I will have to pay the bank to borrow those $100 because they won't lend it to me for free. A pretty basic concept, right? The same way that I might need to borrow money, businesses, banks, and the government also have that necessity and need to pay to do so. This is the Federal Reserve Bank. It's the central bank of the United States, or in other words, it's a bank for banks. When you deposit money into your bank account, the bank is required to keep part of that money in the Federal Reserve Bank because they are required to have enough money to cover their debts. Suppose a bank doesn't have enough money in its vaults. There are two options to solve this problem. It can borrow money from the central bank, or it can borrow money from its competitors. Banks usually prefer to borrow and lend money among themselves instead of reaching out to the central bank. Yes, commercial banks do help each other, but as we learned, banks also have a cost to borrow money, and that cost is called the Fed funds rate. The Fed funds rate is the interest rate banks charge each other for lending money when they need to meet reserve requirements. Now is when you will understand everything. Are you ready? Every time you take out a loan, whether to buy a house, a car, use a credit card, or any other type of loan, your bank will pass their cost to you, which is how much they had to pay to get that money. And they will also add a bit more to make a profit. After all, a bank is also a business. So if the Fed funds rate is high, banks will have to pay more to meet their reserve requirements. And as a result, they will have to raise how much they are charging consumers and businesses for loans. If the Fed funds rate is low, banks can lower how much they charge. The Fed funds rate is the mother of all other interest rates, and not just that, but it also moves side to side with inflation. The Federal Reserve System, also known as the Fed, aims to stabilize the financial system by controlling inflation and verifying that the American economy is growing and doing well. The Feds have a committee that meets 8 times a year to discuss how the economy is doing and see what tools they will use to improve it. The person you probably see more often in the news is Jerome Powell. He is the chair of the Federal Reserve. Every time that the committee has a meeting, economists and people from the financial market pay attention to see if they will increase or lower the target for the Fed funds rate. When interest rates go up, as it's happening right now, the Fed funds rate is at 3.25%. People and businesses avoid taking out loans because it becomes too expensive. It also suggests that people are more conscious and avoid spending the cash that they got in their pockets. If I plan to buy a house or a car, I will postpone it until interest rates are lower. If a company also plans to expand, develop new products, or hire employees, it will also wait for interest rates to come down. This ends up slowing down the economy. There's less money circulating because people prefer to save rather than spend. When interest rates go down, people and businesses spend more happily. Everyone wants to buy a new car, change their appliances, get a new smart TV, or buy a home, even if they cannot afford this out of pocket, because now they can get a loan that won't cost them that much. Companies start to expand their business, hire more people, invest in new strategies, and innovate. In this scenario, there is a lot of money circulating in the economy. There is a significant demand for products and services because people want to buy. But what usually happens when there is a high demand? Supply starts to decrease because there is not enough goods for everyone looking to buy. There are more buyers than is possible to produce to sell, and that generates something called inflation. Prices start to rise. When that happens, the Fed will raise interest rates, borrowing will become more expensive, people will stop buying so much, prices will start decreasing. Did you notice a pattern? When inflation is high, the Fed increases interest rates. When inflation is low, the Fed lowers interest rates. I hope this brief explanation made sense and helped you picture how everything is connected in the economy. Leave your comments below if you would like me to make more videos explaining these essential concepts. Thank you so much for watching, and I will see you in the next one. Bye!